Hello and welcome back to Understanding Crypto. My name is Herve, and every other day on this channel I try to bring you crypto in the easiest way possible on the internet. On this channel is where we cover things like predictive analysis, research and tutorials to help guide you through this vast world of coins and tokens. So if that's the type of content you find interesting, be sure to like this video and subscribe to the channel with your notifications on so that you don't get to miss any other value-packed video like this one. I will leave handy links below in the description for you if you need to sign up to any exchanges or maybe buy a hardware wallet, which you do need if you do not have one yet. I will also leave timestamps down in this video so that you can skip to the part of the video that interests you the most if you are pressed for time. But if you watch all the way through, I will really appreciate it. Okay, with that said and done, let's just jump right into the video. Today we are diving into a very crucial concept in futures trading which some of you have been asking me to cover: liquidity. You may have heard this term before in my other video where we talked about liquidity pools in DeFi. The link to that video will be in the description as well. This time around we are actually talking about liquidity in the context of futures trading and even in the spot market actually. So, to refresh your memory, liquidity simply refers to how easily an asset can be bought or sold without significantly impacting its price. You can think about it like so. If you are trading an asset with high liquidity, it's like stepping into a busy marketplace where you can quickly exchange your goods without affecting their overall market price. The importance of not affecting the market price is because if your sales can cause the price of the item to drop, it means you will actually end up selling the last unit of that item at a lower price than the first one. It also works the same in the buying scenario. If your purchase of an item can cause its price to increase, therefore there's a chance that you will end up buying the last unit of that item at a higher price than the first one. This simple definition can actually explain why BlackRock is not just going to buy Bitcoin from Binance or Binance, because if they do, Bitcoin's price will increase, making it more expensive for them to buy. To go around this effect of increasing the price by their massive buy orders, they buy over the counter. So not in the open market like you and me. They buy over the counter. They call it OTC. So when you hear me talking about OTC, I mean this. An asset that is highly liquid is one that buying or selling it won't cause a significant change to its price, whereas an asset that is illiquid is one whose price will be significantly affected by a buy or a sell. Of course, this is all relative. The dollar is more of a liquid asset than Bitcoin's BTC, whereas BTC is more liquid than some shitcoin on Uniswap. So we see how relative this can be. Now that we know all of this about liquidity, the question now is, how does it work in the derivatives markets? Why is it so important, and how to use it to your advantage? To fully grasp the knowledge, we need to understand how longing and shorting work. When you go long on a certain futures contract, essentially what you're doing is you are buying that contract from your broker or exchange to sell it at a higher price and make a profit from the price difference between your buy and your sell. This is pretty much understood. You buy low and sell high. So you can go long on 10 BTC contracts from a price of $20,000 to sell at a price of $25,000. That way you make $5,000 per BTC. Conversely, when you go short on a futures contract, what you're actually doing is you are selling that contract at a higher price to buy back at a lower price. But wait.
You don't have it. And yet you have the audacity to ask the bank for money.
Apparently.
You don't have it. How can you sell what you do not have? Let's look in deeper into how this dynamic works. So, let's say you think BTC is going to go down from a price of $20,000 to a price of $15,000. Instead of just watching it plummet, what you do is you go to your exchange or broker and you go short on BTC. Here is how that actually works behind the scenes. By going short, what you are actually doing is you are borrowing from your exchange to sell it. Of course, you have to give back what you borrowed. So you borrow 10 BTC at a price of $20,000 and you sell this BTC for $20,000 each at market. Yeah, so you borrowed, its price was $20,000 when you borrowed it, and you sold it for $20,000. When the price goes down to $15,000, you buy back the 10 BTC you borrowed, but you are buying it back for $15,000 each. So you would make $5,000 per BTC as you are buying back at a $5,000 discount. This dynamics, ladies and gentlemen, is what actually happens behind the scenes when you click that short button. If you're liking this video so far, give it a like. I will really appreciate. There comes a problem though. What if instead of the price going down, it goes up? Because you can never be always correct. There will be a time that it did not go down. Or let's say in the longing scenario, what if instead of the price going up, it goes down? What happens then? Well, it takes your stop loss. So what is this stop loss? After performing your analysis, be it fundamental or technical analysis, you set a zone that if price was to go past, it will completely invalidate your thesis. For instance, if you are longing what seems to be a double bottom, your stop loss is likely to be below the first bottom, so below the low of the first bottom. So if the trade doesn't go your way, you will be out of the trade as price reaches that stop loss. I know I am over explaining here, but feel free to skip to any part of the video that interests you the most with the timestamps below. Now, this concept of stop loss is used to manage the risks associated with trading. When you long, you must sell to realize a profit. When you short, you must buy to realize a profit as well. And you must give back the contract to your broker. Remember that you didn't have the contracts to sell in the first place.
You don't have it.
So each time you go long or short, you place a take profit and a stop loss, which is in itself a sell or a buy order. These pending buy and sell orders, which you would call your take profits and your stop losses, will need another party to get them filled. You cannot sell if there's no one willing to buy, and you cannot buy if there's no one willing to sell. So essentially, you need liquidity, and you need a very liquid market to execute these orders at their set prices. If not, your take profit or your stop loss may be skipped. This is where market makers come in. They are called market makers because they basically make the market by providing liquidity, the ease of exchange. Without them, you'd be longing, say, Shiba Inu to take profit when it moves by 10%. Shiba Inu moves by 10%, and you can't close the trade at the exact price because there is no one willing to buy that contract from you at that price. So there's a need for an ever-present liquidity in the marketplace. That way, market participants like you and me can trade easily and not have to get slippages on our orders. This is why market makers are important. A good comparison for market makers in decentralized finance is liquidity providers. My liquidity pools video is in the description of this video. It will go a long way to really help you understand fully how liquidity works both here and in DeFi. Now, the market maker is in by no means Jesus Christ. They are not just there to provide us with liquidity so that we can execute our trades and live happily ever after. They must make money too. By providing liquidity to the market, the profit from the difference between the buy and sell price is called the spread. To realize this, the market maker continuously quotes both a buy or bid price and a sell or ask price for any asset, in this case, contract. This bid price represents the highest price at which they are willing to buy a futures contract, while the ask price is the lowest price at which they are willing to sell a futures contract. Remember, for you to buy, there must be a seller, and for you to sell, there must be a buyer. So they are continuously quoting both a buy and sell price for any contract. So basically, they provide liquidity by offering both the buy and sell prices for futures contracts. This means that when you close your trade for a profit, you are actually taking their money. By offering both buy and sell prices, they create a two-sided market where buyers and sellers, aka long and short traders, can enter the market at any given time. So it's because of the fact that they provide us with these prices that we can trade at any moment. Now, if on a BTC contract the market maker quotes a bid price or buy price of say $30,000 and an ask price or sell price of say $30,100, the spread in this case is $100. So they can potentially make $100 for every contract that is traded within this spread. Now, of course, they handle a significant amount of volume, which allows them to capture multiple spreads in a single trading day. So it's not just like they're making $100. We're talking like multi-millions here. Whales and exchanges are not the same as market makers, by the way. They can be, but not necessarily. One thing you must have heard before, be it from me or online generally, is how longs and shorts got liquidated. And you'd wonder, what does that even mean? When a trader holds a long position, they are essentially betting that price will continue to go up. When a trader holds a short position, they are essentially betting that price will continue to go to the downside. To maintain this position, they must ensure that they have sufficient collateral, which in this case is called the margin, in their trading accounts to cover for potential losses. So this margin or collateral basically guarantees that you can afford that position and you would pay if price was to go the other way. If price moves against the trader's trade idea and his account balance falls below the maintenance margin level or collateral level, the exchange will issue a margin call. This call is to let you know that the position you are in needs more collateral or margin. The trader in this case will either have to add more margin to his position or close the position in a loss. If the trader cannot add more margin, then the exchange will automatically close the position to cover for the margin deficit. This is what is called a liquidation event. So for long positions, this will mean selling the long position, and for short positions, this will mean triggering a market order to buy the contract at the best available market price. Again, it all comes back to the market maker because they are the ones providing the liquidity and benefiting from the spread, which we mentioned earlier. So when traders get liquidated, market makers capture spreads as they execute buy and sell orders to close out those positions. We can clearly see how this gives them the incentive to want to push price to zones where liquidation events are likely to occur. The spread between the buy and the sell order contributes to the profit, and these liquidation events lead to increased trading activity and high volatility, which again is what they can use, as a higher trading volume means that they can execute a higher number of trades, thereby capturing more spreads and more money for them. So they didn't just come to save the world, they are here for business. They can go as far as placing significant buy or sell orders that may move the market to a particular liquidation zone. And to be less conspicuous about this, they may use news events. That way, it becomes less apparent that they are moving the market, at least to the average retail trader. I say average here because we are all retail traders. They even use methods known as spoofing and layering tactics, whereby they place and cancel orders to create the illusion of significant supply or demand near liquidation levels. This may attract market participants to those levels, and of course, most retail traders won't know that it's all a trap. What's important to understand here is that market makers may place their orders above resistance or below support zones in an attempt to drive price to those areas, which will trigger stops or liquidate traders. So in other words, retail buys at support and place their stop losses below support. Institutions buy below support. They basically buy your stops. Something to remember. Understanding this, one can potentially try to think like market makers when trading or investing. One must ask, what would institutions be doing at this point? And what would the average trader be doing at this point? And yes, institutions are mostly right. So interrupting this concept into one's trading and investment strategy could really fine-tune one's success rate. Speaking of investment strategy, we've seen how market makers may influence price in the futures markets. And yes, we do have market makers in the spot market as well. But someone asked me the other day here on YouTube, one of our videos. The person asked, aren't the two prices the same? That's the spot price and the futures price. And the answer is not really. The spot price represents the current market value of an asset. It's the price at which that asset can be bought or sold for immediate settlement. So it's like the real-time price you would pay to acquire Bitcoin right now or any other asset. The traditional or standard futures price is the price agreed upon by buyers or sellers in the futures contract, specifying the value at which the underlying asset will be bought or sold in the future. So basically, the future worth of that asset, not present. This price can closely track the spot market price as traders use it for arbitrage and risk management techniques like hedging their positions. So basically going short on, say, a Bitcoin contract and simultaneously buying Bitcoin on the spot market and vice versa. Perpetual futures prices, however, which is what most of us trade, are different from standard or traditional futures as they are designed to closely track the spot price. This is maintained by issuing funding rates, which is what we talked about in our other video. I'll leave the video in the description for you. It's a short video, so yeah, you can check it out. Now, we've talked about a whole lot, but hopefully you now understand that it's not only people like you and me in this marketplace. It's a whole lot of participants, all with the same goal, to make money. And we are going against institutions who do not only have a lot of money, but some serious techniques up their sleeves. As we said earlier, these market makers are not just limited to the futures markets. They are in the spot markets too, together with whales. Alameda Research was a market maker at Binance, by the way. So if you're just wondering what's an example of a market maker. Alameda Research, founded by Sam Bankman-Fried, was one of the market makers. They also provided liquidity on Serum, one of Solana's dexes. They all communicate with each other and have good tactics to move price to liquidation zones where a lot of people are bound to lose a lot of money to them. They make us believe that we are in a bull market or keep us thinking that we are still in a bear market. They control the marketplace. In the end, it is by the understanding that there are bigger and highly sophisticated players in this marketplace that we can truly start to think rightly. They buy at a discount and sell to retail at a premium as retail gets excited for some event. They break resistance on purpose and sell to retail as retail believes that the drop is over, and they break support and buy from retail as retail sells in panic. This, my friends, is what we must understand. Stay safe.